You been, we move faster along, but go further together. We can weather any weather forever. A dream team, I done seen things, confidence is on 100,000. I got family for miles.
Morning, everyone. What's going on? Happy Saturday, man. Come on in to the Zoom session. Come on in, turn your cameras on so we can see who we seeing. Good morning. Man, we're going to go through a lot of information this morning, man. Grab your notepads, buckle up your seat belts, man. We're going to have a lot of good times, some fun, some participation back and forth. But most of all, we're going to get a lot of knowledge, man. This morning, I'm bringing some information with you to you guys today, as well as one of my preferred lenders, Mr. Aaron Duez, is going to be helping us bring some knowledge today. And so we're going to go ahead and get rocking and rolling. So first thing first, just want to make sure everyone knows how to use the Zoom control panels as we get started. And first thing, let's see if we all know how to work the chat feature on Zoom. So here's what I want you guys to do. First of all, if you have anybody that you invited to this session, maybe you shared the link, please hit them up real quick. Let them know we are live, and we're getting started. The session generally locks after about 10 minutes of start time. So go ahead and hit them, call them, text them real quick, let them know we're on. So let's get back to the Zoom control features. There should be a chat feature somewhere on your Zoom. It should either be directly on the Zoom panel, or depending on your device, it could be in the three dots that's titled More. Click the three dots, and then you may see the chat inside the More function. But I want you guys real quick just to go into the Zoom chat and type in your location. Shout out your city and state where you're logging in from today so we can see where everybody's position. I'm going to put mine in as well. Right.
Good morning.
Morning. Let's get those city and states going. Let's get them going. Let's light up the chat. Make sure everybody knows how to use these functions, because we're going to be communicating a lot today back and forth. And all right, let's see, Fort Lauderdale. iPad, who is that? Throw your name in the chat as well. I'll change the name on the screen. I thought y'all was Zoom pros, man. What's going on? Yamari Hudson, Miami, Florida. I see you. Jacksonville, Akron, Ohio. Okay. Well, good job. Tierra. Okay, let me change it to Tierra real quick. I don't want to call you iPad the whole meeting. Right. All right. Next thing, Ishmael, Miami. Okay, so we all spread out a little bit today. And see Charletta's coming on now. That's Jacksonville, I'm sure. And so good job. So we got some Florida, some Ohio. All right, Ohio's in the building. Welcome. All right, the next thing we're going to work on today is our microphone. So on the count of three, what I want you guys to do is to unmic your microphone, unmute yourself on the microphone. On the count of three, I want you guys to say your best good morning greeting, your good morning shout out, whatever you normally do when you're passing people and you want to say good morning, your greetings and salutations. Everybody on mic real quick. On the count of three, we're going to get our best greeting on. 1, 2, and 3.
Good morning.
Good rising.
Everybody's alive and awake this morning.
Good morning.
Awesome. You got your coffee. I got mine here. Right. All right. Good morning. We're going to go ahead and get rocking and rolling. So first of all, my name is Marlon Conaway. We run a financial agency called Legacybuilder 904 Consulting. I'm also a licensed real estate agent through Florida Homes Realty. And my mission base is to help families become properly protected, debt-free, financially independent by educating and implementing the key principles of putting their financial house in order and creating generational wealth. And when I'm not working hard, grinding like everybody else, I have 3 beautiful children, Mackenzie, Mason, and Matthew, that keep me busy with their activities, with daddy duties. And every now and then I get to go out and have a little fun in the sun, and hopefully I can catch some beach action this weekend and everything. So Mr. Aaron Dewey, would you like to introduce yourself real quick? This is my partner, Mr. Aaron, on here.
Yeah, my name's Aaron Dewey. I'm with Loan Depot. Been with them now for a while. Been doing this business now for about 26 years, and not just sucking up, but if Marlon here, if you ain't using him, something's wrong, because there's a lot of realtors in North Florida and all over. And I got to tell you, there's real and then there's fake, and this guy is real. So he's here to help you, take care of you, and lead you in the right direction. And all kidding aside, this guy is an ace, and I only deal with aces. There's plenty of fake out there, because I see him all the time. I talk to him all the time, but he's really about giving and helping and sharing knowledge. And it's not about the transaction. He's truly about relationships. So that's why I love doing business with him.
Awesome, awesome, awesome. Well, great job, great job. And guys, hey, we're going to go ahead and get rocking and rolling. Let me go ahead and share my screen. If you're on here today, most likely you've come to one of our financial seminars in the past, and you kind of work with us on different areas of your finances, trying to get your finances in order and putting the building blocks in order to achieve financial freedom. All right. And so what I'm going to have everybody do at this point, just go ahead and mute yourself back out. And then throughout the session, as we go through, we may do some Q&A. You know, you can use the chat feature, or you can use the microphone to give your response. If you have any questions along the way, what I'm going to ask you guys to do is throw all questions in the chat, and we'll try to handle them as best as possible, either through the presentation or on the back end, so we're not dragging this out. We want you guys to be on and off within hopefully the next 40, 45 minutes, hour max, so you guys can enjoy your weekend, okay? And so if you are here to the channel today, most of you guys probably met me initially through coming to the financial literacy webinar. Right now, we're working with you on some capacity financially, whether it's insurance, auto, homeowners, Medicare health plan, legal insurance, debt elimination, retirement, or what have you. Today, we're going to have a real estate conversation. I believe real estate is one of those essential building blocks to achieving your best financial life. And so we're going to get into that today. One of the biggest things that we really focus on is the wholeness of personal finance, all right? Not just working in one particular area. I believe in diversification. And I believe there are basically 4 money houses that all wealthy people store money. 4 money houses that all wealthy people store money. Number 1 is insurance. The second money house is investing. The third money house is business ownership. And the fourth money house is real estate, all right? So today we're going to have that conversation, all right? Because some of you guys may be on the road right now. We're just looking to purchase your first primary home. Some of you guys may have a primary home, and you're looking at now buying a second or third home, maybe for investing purposes or what have you, right? Or maybe just buying homes for the family, right? For your children. So whatever your needs are, we can assist you guys through the entire process. So I'm going to jump off real quick, and Mr. Aaron's going to help us out a little bit as we go through each area. I'm going to kind of be passing the mic to him for him to jump in with his expertise. We're going to tag team today. But one of the biggest things that a lot of people right now, they're on the fence, right? They see interest rates rising, and they're like, Marlon, you know, I want to kind of wait this thing out. You know, I mean, rates are, Aaron, right about now, national average, what would you say interest rates are as far as home loans, 30-year mortgage?
5.25. So
people see that, right? And they say, well, man, my friend bought a house, they got a 3% loan, right? Well, if you look at rates over the decades, right? In the 70s, average rate was about 8.86, 80s, 12.7, 90s, 8.2, 2000, 6.29, 2010s, 4.09, in the 2021s, 3%. And now Aaron just hit you with that 5 point whatever, okay? And you're thinking, man, should I wait? Well, first of all, I was born in the 70s, all right? I'm 50 years old, and it took nearly 50 years for rates to get down to 3%. Now, I don't know how to predict the future. It could get back, but I know the first time it took 50 years, right? Okay, right? I'm just saying, I don't know if you want to wait that long. So what I always tell people this here is when you're renting, your interest rate is 100%. Would you guys prefer 5 or 100? All right, most people say 5. When you're renting, you build no equity. All the money goes into the garbage or into the equity of the landlord, right? Of the person who owns the property. You're paying his mortgage down, all right? And so I always tell my clients, listen, get in where you fit in. When I bought my first house, rates were right about here. When rates got here, guess what we did? Refinance, right? Okay, get in where you fit in. Man, buying a home is very, very, very important, right? If you bought a house at 5, what have you, if rates decide to go back down in your lifetime, that's a perfect time to refi, all right? But waiting around, we don't know what's going to happen in the future. And it took a long time to get to that point, okay? And so we just never know what's going to happen. But one thing I want to tell you, and I'm going to want you guys to do a quick little exercise. If you're taking notes, what I want you guys to do, if you're renting right now, I want you to write down your average rent payment since you've been renting. So right now, if you're renting and your new rental payment has went up to, let's say, $1,800, but when you first came out your mama's house and you got your first place and it was $1,000, just divide those two numbers. Just write down $1,500 on paper, right? Just write that down, right? So write down your average rental payment since you've been renting, okay? I'm gonna play along with you on the screen real quick, all right? Now I want you to multiply that number by 12 to get your annual rental payment. I like to call this the fiscal checkup, right? So let's say 1,500 average, times 12 months, right? So on average, 18,000. Right now, I want you to now multiply that by the amount of years you've been renting. So if you've been renting for 10 years and you've been paying on average 18,000 a year, that number right there is your cost basis, right? That's how much you have thrown away in rental payments. That could be equity. Does that make sense? Okay. Aaron, what's your thoughts real quick on rates and waiting around and, you know, a lot of the sentiment that a lot of people are having right now?
Well, here's the thing is that, you know, being able to refinance, like Marlon said, is that you can always refinance later when rates come down, and they are projected to come down next year sometime, possibly in the third quarter of next year. But we know one thing's for certain: housing is not declining. What we are seeing is a correction, not what we saw in 2008, which was a crash. There's a difference in a crash and a correction. So everybody was paying overpriced for a house. Now people are paying what the house is actually worth and financeable according to what the appraisal, which is an evaluation of what the home is going to sell for in a general market and within that neighborhood. So the question is, would I rather pay a payment at 5.5% interest rate, let's say, or do I want to wait until rates are at 3% or 3.5% in a year and a half from now and miss out on the opportunity today? So if values continue to go the way they are, and they're continuing to go up, values are going up anywhere from 10 to 15% here in the greater Jacksonville area. So do I want to wait a year and pay 15% more for the same house just to have a lower rate? The answer is probably that's not a very wise financial decision, because you can always refinance. That would be my answer to that question.
Absolutely, absolutely, right. And I tell you what, that house that we talked about at 6% when we bought it was like 168,000. That same house today is like 300-some thousand. So what he's talking about is the high cost of waiting, right? Instead of buying
the other thing I would share with you is that through the data that I see and I look at every day, you know, rent isn't getting cheaper. Rent is forecasted to go up at least 10 to 12% over the next year and continue to climb. If you look in the Jacksonville market, and I'm sure it's like that down in Fort Lauderdale. I saw somebody from Fort Lauderdale and I believe somebody from Miami. It's even higher down there, but in North Florida, the rent's going up anywhere from 10 to 12%. So you're already going to be paying more for your rental. Why not pay a little bit more for a house now and being able to refinance it later?
Absolutely, absolutely. So now we're going to talk real quick about some type of different types of home finance. Now, credit scores and all those things may vary per lender, and I'm going to have Mr. Aaron talk about these different types of finances, who they're for, right, and what the possibilities are with the different types of financing, and the average, you know, I know everybody's concerned about credit score. You know, what type of credit score do I need for FHA, whatever. Okay, he's going to hit on those things. All right. In parentheses, I have, you know, averages that I've been seeing in the area, but I'm gonna have Mr. Aaron kind of discuss, you know, conventional FHA, VA, USDA, and of course, cash doesn't need any explanation, right? There are a lot of cash buyers out there. Okay, but you want to touch bases on these real quick, Aaron? Conventional and FHA and all those different loans.
Yeah. So on conventional, you're going to need a credit score of 640 today. That's going to be a better scenario for you. FHA and VA, we can go down to 520. That's 520, not 580 or 620, but 520. So every lender is a little bit different, with Loan Depot being a servicer of your mortgage, meaning that we're going to hold the mortgage and you're going to pay Loan Depot the payment every month because we want to build relationships. And so we have a big enough piggy bank that we can finance all the loans ourselves. we're going to want to be able to create a relationship. So we can go down to 520. Other companies are out there where they have to sell their loans to other people. And so therefore, there are things called overlays where they have to be prepared to sell it to somebody else that is not themselves to service the loan. And so everybody is going to put what we call overlays or distinguishers on what they're willing to accept and not accept. So because we're an actual lender, not a bank, not a broker, we're the person that actually also services a loan, we're going to be able to go down to a lower credit score. Now, with the lower credit score than what you see there on their screen in the blue, it is going to cost you 10% as a down payment. Because if you have a 520 credit score, there must be some things that must be wrong with the credit. Now, I know we're going to talk about credit in a minute, but do not let credit be a deterrent from you applying online and looking for financing. Because what I tell people is simple. It might be today, it might not be today, but it will be someday. So I'm going to show you what you need to do with your credit in order to get in the position to be able to buy a home. That credit information is free. I'm going to give it to you, and then it's up to you to make your dreams come true. I'm going to give you the information for free. It's up to you to take that information and then be able to execute it. And within 2 months, 3 months, 6 months, I've had people I've worked with for a year. And I got to tell you, I get more joy out of those people because they worked to get to what they needed. It wasn't just they had a great score and they just went into a house and could use anybody. We helped them get to where they wanted to be and help them make the dream of home ownership a reality.
Absolutely. So what did you say? What did you say conventional was?
640.
640. Okay. Now, as far as something like down payment assistance or having lower down payment instead of 10%, what do they need to be ballpark figure?
So for everything on the screen is correct. So conventional, you can do 3 or 5. FHA, you can do 3.5. On VA is 100% financing. So if you're a past veteran with an honorable discharge, you can get 100% financing. You will be responsible for closing costs, but there are down payment assistance like we talked about. USDA is depending on certain areas, which we call rural areas, like a St. Johns County, Clay County, Nassau County. Those kind of counties are going to be considered to be rural, and you can do 100% financing in that area. And if you're rich and you got all cash, well, then just don't forget about me when it's my birthday.
Absolutely right. Drop the cash app in the chat. Right? Okay. Anybody have any quick questions on the financing aspect before we move on to how to qualify for home? All right. Not throw it in the chat. We'll get to it. And so, Aaron, what you recommend, and this is what I always recommend myself, is take an app. Take an application. Find out where you are.
Doesn't cost you anything. Don't
cost you anything. Aaron's going to coach you from there. Right? He's either going to say, hey, man, you good to go right now. Or he's going to say, hey, we need to tweak this, tweak that. Let's follow up in 2 months. Come back for your follow-up, and then we reevaluate. Is that correct? That's what we're doing, right?
That's it. I mean, knowledge is power. And by us being there to create a relationship with you and hold your hand and walk you through the process, look, people don't buy a house every day. You know, they buy a house once every 5 to 7 years. And so helping with that processes change on a regular basis. So being there to walk you through that process and help you and handhold because you're new, you've never done it before, or whatever the case is, we want to make sure that we make it as easy as possible.
Absolutely. Absolutely. So let's look at what are some of the things that lenders look at when it comes to qualifying somebody for home. We mentioned credit a little bit. What are some
So the first thing we're going to look at credit. The second thing we're going to look at is your work history. Now it says 2+ years. Now work history can go all the way back to you working at Burger King while you were in high school. So let's say you're 21 years old, you're in college, you're done with college, now you're working a full-time job. I can go back and get 2 years of work history from you working part-time jobs. So 2-year work history isn't ever really a problem. The other thing that we look at is assets. So do you have enough money to close? And then after we look at that, we're going to look at your debt to income ratio. So your debt to income ratio is your gross income for your full-time job, not your net, not after they take out taxes and insurance and all that kind of stuff. But we're going to look at your gross income. We're going to multiply that times 45% on in general. And then we're going to subtract what your debts on your credit report are, such as a car payment, your credit cards, an installment loan, your motorcycle payment, those kind of, your furniture payment, those kind of things that are reporting, not what your lights are costing, not what your insurance is costing you on your paycheck, not what, your cell phone is. So we're not going to count those miscellaneous things. We're going to count things that are actually on the credit report. And the only thing that's not on the credit report that we would count for or against is child support.
Right. All right. And so what you're saying is, if in the event I have a 700 credit score, but my debt to income ratio is out of whack.
Right.
Maybe I have no money saved in my 401k in the bank, IRAs, whatever. It could be a problem.
Well, again, there's ways to get around the asset piece, right? Because you can always get a gift from a family member. You can get down payment assistance money, which we have. You can get around the assets. So don't let any one of these things detour you from applying to be able to see where you're at to create a starting point, because your debt to income ratio is still going to qualify you for something. It might not be what you want, but it is going to qualify you for something. And so then we look at, okay, so how do I get from $150,000 to a $250,000 home? Okay, so then we take that in consideration. So it's really setting goals that maybe you're not buying today, but we're going to show you how to buy. And when you're ready to buy, we're going to be there to help you walk you through that process. Many people get scared of the situation or the process and go, oh, that's too much. Again, we're going to make it simple for you. We're going to show you where you're at, and then we're going to help you to get to where you're going or where you want to be. There's a big difference in those two. A lot of people would look at credit and just take it for face value. There's a lot of things that are wrong on credit reports. In fact, 86% of all credit reports have mistakes on them. They have AKAs where somebody misspelled your name when you were filling out a credit card at JCPenney's or something, right? So all these things are mistakes on a credit report, and we can fix that for you and be able to help you get into a better situation on your credit score. So credit scores can be changed literally in a week. It's simply by the debts that are on the credit report versus what your beginning balances were when it comes to credit cards. Length of time is what's going to help your installment loan. So a car loan is considered to be an installment. A credit card is a revolving, so those go up and down. So we're going to take a look at those and be able to advise you. Just last week, I changed somebody's credit score from a 640 to a 680, and it simply had them paying one credit card down by $50. So those kind of little things that we're experts on can help the consumer or our customer be able to get to where they want to be and be able to get a good rate, a good score, all those kind of things.
Now, Aaron, touch base on gift real quick. When we talk about assets, you mentioned gifting. Explain to our listeners today what a gift and what qualifies as a gift.
So a gift is something that a family member is giving you. It can be a fiance, it can be a cousin, it can be a brother, it can be an aunt, an uncle, parents. They can give you gift funds in order to qualify for reserves or your down payment. But there's also a lot of down payment assistant programs out there here in Duval County and throughout Florida that we're able to help you with for the first-time home buyer. So a first-time home buyer is somebody that hasn't owned a home in the previous 3 years, which is why we collect 3 years of tax returns, not just 2, to be able to verify that you haven't been a homeowner in the last 3 years.
Awesome job. So now we're qualified, right? We sitting in the application. You said, man, thumbs up. Okay. What type of additional information we need to provide
right.
to make that offer solid?
So these are the basics, right? There might be additional, but these are always going to be the basics. So we're always going to ask for the last 2 months of bank statements, full statements, not the ones you print off to check down your checkbook, right? Balance your checkbook. So the statements that we used to get in the mail, which are online, the last 2 years of W-2s, 30 days worth of paycheck stubs. Don't worry about your monthly debts because those are going to come up on their credit report. And then the last 2 years of tax returns. So 2, 2, 4, if you get paid weekly for pay stubs, and then 2 years of tax returns. So we really want to see where you've been for the last 2 years and where you've been at year to date is what we're looking for.
Awesome job. Awesome job. All right. All right. So we got some questions in the chat. We're going to hold those off to the end. And so y'all keep the questions coming. And great job with the question asking. Sometimes rent to own may be an option. We have a couple partners in there. I won't touch on it too much. Sometimes people may say, hey, like he mentioned, the cost of housing is going up. I'm going to jump on something. Not mortgage ready yet. Okay. They want to explore the rent to own option. And then on the back end, when it's time to purchase the home, then now you got Aaron, who's been working with you for the last 12 months, 24 months, your financials together to be able to get that home loan. So now you can solidify that deal. So we'll talk on that more one-on-one. For those that may be options for some of you guys, let's touch on some of the do's and don'ts when we're going through the mortgage approval.
Sure. So one of the biggest things, if you have cash, you want to go ahead and deposit that into your bank now. And the reason why we want to see it deposited into your bank now is because if it's a large amount of money, we are going to want to see it seasoned for 2 months in your account. So let's say somebody gives you $5,000. Well, if you're only making, $1,000 a month and you make a big deposit of like $2,000 into your bank account, we're going to ask where that came from because we're going to see it. Or if we see continuing debt that's paid out to the same person for the same amount on your checking account, we're going to want to see what that is. That could be child support. That could be an extra debt that's not on your credit report, which is unlikely, but it does happen. So if you have cash that you're stowing in the bed, under the bed, which does happen a lot, I got cash in the safe as well, and you're looking to buy a home, the best place for that is to go ahead and put it in the bank so that we can go through the part that's called seasoning. It has to be there for 60 days.
All right.
Don't go out and buy a new car, for sure. Please don't go out and buy a new car. Now, if your car is on the last leg and you need to get a new car, that's fine. But let's look at the credit and let's look where you're trying to qualify for. Maybe one car debt is going to replace another car debt. And so therefore, then we can see exactly where we're at and be able to give you advice on how much a car payment needs to be. Where do you need to stay within in order to reach your goal? But just don't go out and add debt at the current time when you're looking to buy a home. That's a big no-no. Don't co-sign for others. That's a big one. But if we're trying to help you build your credit and you have a parent or somebody that makes all their payments on time, by them adding you as a authorized user on the credit report, that could help your credit score. So there's ways to increase your credit scores, but the last thing we want you to do is to go out and co-sign for somebody else, because then even though they're making the payments, if we don't have a year history of them making the payments, that's going to be part of the debt that we're going to have to count against you in your debt to income ratio. Don't change bank accounts. So a lot of people will go in and say, oh, like BuyStar right now, I'm changing my bank from BuyStar, or I'm moving a lot of cash from my savings to my checking, to my money market, back to my savings, out of my 401k. The last thing you want to do is to be moving money around. Let the money stay where it is and we can get it all together at the end, but don't move money around, because that will make the process more challenging, not hard, but just more challenging and frustrating for you as the consumer, because we're going to want to find out where every transaction went to. What did that money go to? Where did it come from? So we're going to just ask you more questions, which can be frustrating, and we don't like to do that to our consumer. Don't apply for new credit. Let us look at your credit and see where you're at, and then we can evaluate what we need to do. So don't just take it upon yourself to, okay, I need to get all these new credit cards. We'll tell you exactly how many credit cards you need and what the balances need to be. So let us help you with that. Let us tell you how much to pay down on a credit card. Don't just assume, hey, if I pay this down, if I pay this all the way off, my credit score is going to be good. That's not always the case. Credit's really, really tricky, and the consumer doesn't totally understand. And that's not your fault. It's just because it's something that we've never really been taught. The only thing we were ever taught was pay your bills on time, but we were never taught on really how credit can truly help us and do what we need it to do. Don't close any credit card accounts. Let us advise you after we look at your credit score to see what happens. I'll give you an example. Sweet old lady came in to refinance her house. She had 10 credit cards. They all had about 50% debt to income ratio on all of them. Everything was fine. She was ready to go. She was getting a great rate. She was getting cash out. She came back because she got a card in the mail that says 0% interest on any balance that you transfer. So guess what? She transferred all of her balances to the one credit card. So now she's 100% maxed out on only one account and doesn't have any of the other accounts because they were closed. Now her credit score dropped from like an 800 to a 500. That wasn't beneficial for her, and the consumer just doesn't know. So let us advise and help and consult with you through that process to help you get to where you want to be.
Awesome job. Now, Aaron's contact info is in the chat, guys. You can copy and paste that somewhere, and you have where to reach him. So real quick, guys, I want to go through some Q&A real quick, and then we'll wrap up with the path to home ownership. And we'll be, pretty much done for the day. We provide a lot of great information, but most important thing I would just tell you, take the app, and then just follow coaching. All right. And we're going to help you guys get to where you want to be. So I'm scrolling up through the chat real quick.
So real quick, Marlon, there are a lot of down payment assistance programs in the state of Florida that can help you in your way to home ownership. There's a program in Duval County called H2H that you can qualify for. There's the Hometown Heroes program. So if you're a first responder, military, medical, teacher, those kind of things, we can get you in with a down payment program. And there's also the bond programs with the state as well that we have access to because we're a lender, not a broker. So those are big opportunities for the consumer for us to be able to help you. Now, there's a difference in what I do, and I feel myself to be a consultant versus a salesperson. A salesperson is going to try to sell you on one thing. A consultant is going to lay out options for you, which is why I do a lot of business with Marlon, is that we're going to lay out options for you and look at what's best for you and for you to make the decision, not me. A salesperson is going to come in and give you one option. That's going to be it. And you either take it or you leave it. They're not going to spend the time consulting and look for your best interest, because that kind of person is a salesperson. I would rather build a relationship, which is why I partner with people like Marlon, because honestly, I don't like realtors. And the reason is because a lot of them are salespeople. The reason why I partner with your guy here is simply because he's about relationships. How do we do something good for somebody else and not make it about ourselves? So that's something to really take to heart of what we're trying to help you accomplish.
All right. Now, here's the first question. Is an extension payment considered a late or missed payment?
No. So a late payment is only if it's 30 days late. You can pay a late fee on a credit card. As long as it's not 30 days late, it won't affect your credit score. It might affect your pocketbook a little bit, but it didn't affect your credit score. It's only if it's 30 days late is the creditor allowed to put something on your credit report.
All right. Let's see. Next question here. Student loan counts. Now, I know student loan rules been changing, right? Okay. What's the latest and greatest on student loans and how they affect mortgage qualification?
So student loans, if we can have a lot of them are income based. And so we're either going to take 5% of that loan amount and charge that against you, Or if you have a payment from your student loan people, your student loan creditor, if you can get them to send you what a minimum payment would be due, which is income based, we can have that put on their credit report, which is going to be lower than 5% or 10% that the lender would charge you if the number is zero. So I see a lot of zeros all the time because it's deferred. Again, we're going to either charge you 5 or 10% for that payment of that balance as a payment, or we're going to help you contact that creditor, contact that company that's holding your student loan for you, and we're going to have them give you a minimum payment sheet of what your payment would be currently, which a lot of times is much less because it's income based.
Gotcha. So we're not talking about the balance of the loan. We're talking about the monthly payment. So you're
Correct.
saying on 100,000 on a 100K loan, 5% would be $5,000 a year, $450 a month, right?
Yep,
Then you're
that's
saying,
it.
hey, you can call and say, hey, for that same, can I get a payment negotiation of $50? That's what I can afford. You're going to use this when it comes to
Absolutely.
that. Right. So
Correct.
I just want to use some real numbers for you guys so you can see what he's talking about. All right. And all right. Let's look at the next one. Do medical bills really hurt your credit?
Medical bills hurt your credit one time, each time that they hit your credit report. So most medical companies are going to hit you with a medical bill, which there's something in Congress right now that they're trying to pass where medical bills are not going to be able to affect your credit score. Because honestly, everybody has a medical collection practically. And it's simply because what happens is your doctor submits it to your insurance company. The insurance only pays a portion, and then the doctor doesn't spend time over the next year. If you only go in once a year, once every 2 years, he doesn't spend the time saying, hey, here's your balance. So most of the time what they do, they go right to your credit report. And as soon as it hits your credit report, it dings it and lowers your credit score. Well, these collection companies are going to ding your credit score every 3 months that bill isn't paid. Now you can call and negotiate for half of what's on that and not pay the whole thing, but you have to be able to pick up the phone and call once you get that collection notice, if they even send it out.
All right, let's look for some more. All right, so what's the best way to get the medical bills off your credit?
The best way to get your medical bills off the credit is once we pull them and we find them, I'll walk you through a process of how to get the credit report updated and get those removed. We're never going to pay the full 100% of the collection. We're only going to pay a portion of it. And all that is always negotiable with that creditor. So, or the collection company. The collection company gets paid based on what they collect. Okay, so them collecting something versus nothing is always better. So we're going to help you, walk you through a process of how to negotiate that and be able to pay half, maybe a little bit more of that collection in order to get it removed. A lot of credit companies are going to say, hey, you can pay us $100 a month and we'll get all these medical collections removed. What those companies do is they send out a base letter that looks like it's something from attorney to those collectors saying you need to remove this immediately. Well, what happens is they'll remove it, but then 6 months later, when that report comes up again, they see that it's been removed and they'll put it right back on, and then it hurts your credit again. So there's ways to get around that. Don't spend the money on credit counseling. That something that we can do for you for free and be able to give you advice.
Right. So take the app. Aaron's going to work with you from there, getting everything looking squeaky clean to help you out. All right. I'll give you advice on what to do. Last two questions real quick. Car extension. Would a car extension for 2 to 3 months be considered a missed payment?
I would need to be defined a little bit more about that question. So is it that you missed 2 payments and so you put them to the back of the mortgage or to the car loan? It is going to affect your credit score depending on the lender or the creditor on how they reported it. So through COVID, there was a lot of creditors that would not on a car loan or on a mortgage, they would push it to the back of the note on the debt, and they would not count those against you. So therefore, it would not count against your credit. If they counted them as lates, well, then yes, it would affect your credit score because they counted them as 2 30-day lates. I'm not sure if that answered the question.
It just depends on when they put it on the back end of the note. So if you was already late when they put it on the back end, you've already taken those late hits.
Right.
Okay, Aaron, this is Crystal. How are you?
Good. How you doing today, Crystal?
I'm doing well. That was my question. And what I wanted to know is the payments were put on the back. It wasn't late, and it was during COVID.
Okay.
I had that to happen to me twice, but I
Right.
see that is on my credit as late payments, and they wasn't late.
Now, did it affect your credit score? Because many times, like
Yes.
with the mortgage, on the mortgage, we were able to do that because that came out from Congress that you can't count it against their credit report. Now, they would write it on the credit report, but they wouldn't count it against your score. So you would have to get with that car lender and say, hey, we agreed to put these to the back because of COVID, but you counted me for 30 days late. And so that would be something we would negotiate with that car dealer and be able to get those lates removed.
Okay, because I think when I checked my credit score, it said like missed payments.
Mm-hmm. Okay.
And they wasn't missed, it's just they were put on the back end.
They were negotiated, right, to be put on the back. So yes, that is something that they shouldn't have hit your credit score with. Now, while we're on credit scores, there's a big difference in Credit Karma and my FICO versus what we pull as a credit report. Many times what you're seeing on my credit or my FICO or Credit Karma, that is a blank slate with no weight to anything. All they're doing is showing you a base score to give you an idea of where you're at.
Mhm.
When we pull as a mortgage company, when we pull your credit report, it's going to be weighted against the likelihood of being able to repay the debt. So that's a big difference because again, my FICO and Credit Karma isn't weighted. Now, what Credit Karma and my FICO is really, really good for is to see if there's any mistakes on your credit report. Because remember, there's over 80% of credit reports, 83% of credit reports have mistakes on them. So those tools are there to help clean some of those mistakes up that are on the credit report so that when a lender pulls it, it's gonna be typically about 20 points lower than what my FICO or Credit Karma is showing you today.
Okay.
But again, we can show you how to get those scores up. And we also have the contact information, which is also a big deal, is that many times you have collections, you don't even know who they're from, and you don't have the contact information anyway. We're going to have that on your credit report that we can help you with that.
Okay, thank you.
And
You're welcome.
I don't know if the word is called algorithm, but I know there are different type of FICOs, FICO 6, FICO 8, FICO 9. Which one do you guys mostly use when you're doing it?
We're going to use the middle of the three. So there's your common three that are out there is your TransUnion, your Experian and Equifax. Okay. Now, to give you a little bit of history about credit, most people on the East Coast used to just pull the Equifax. Why? Because Equifax used to be just people on the East Coast. And the other one was in the central states, and TransUnion was on the West Coast. With our country becoming so transit, all of a sudden, all those credit reports weren't really truly showing what was happening across the country. It was only showing what was happening only on the Eastern Seaboard. So that's why your lenders are going to get a full look across the country of what your average credit score would be. And so we're going to take the three credit scores and we're going to take the middle of the three. We're not going to average them. We're going to take the middle of the three scores, and that's the one we're going to use to qualify you.
Awesome job. Last few real quick so we get everybody back on their day. Let's see here. All right, so when you settle a debt, how does a settled payment count for or against you?
So what happens is we're going to take that letter and we're going to go right to the bureau and we're going to have it updated immediately. And that's going to take the debt from whatever it was to zero. And over time, that's going to improve your credit score. It doesn't always improve it immediately, but it will improve it over time, as well as a late. A 30-day late is going to hit you one time. It's going to hit you hard. Over a period of time of you making those payments on time, that is going to have less pull negatively on your credit.
Okay, this is part two of the same question. So what does the law pertain to these credit collection companies buying debt for pennies on the dollar and then trying to sue you for the debt? How much validity and all that debt?
So what happens is many times it's kind of in my opinion, it's kind of a scam, because creditors will sell the debt to a collector. That collector is buying it for pennies on a dollar. Let's say he's buying it for 50 cents on a dollar. He's going to try to collect it for 2 years. Then he's going to sell it to another collector that's going to pay 25 cents on the dollar. And then that one's going to sell it to another one 2 years later. And so now you have all these creditors on there that's not really accurate. So the sooner we can get to them and negotiate that price out, the better. The negative part is that they're all allowed to hit your credit report because now they own a debt. Now, there is a thing in there in the state of Florida. If you've had a collection for 3 years, after the 3rd year, the creditors can still try to collect on the debt, but they cannot make it a lawsuit and make it a lien against anything you purchase, such as a house. So that is a law in the state of Florida. A lot of lenders will say, oh, well, they could turn that into a lien. It's just simply because the lenders don't know what they're talking about. It has to be on there for 3 years in order for it to even become a lien. And honestly, if it's a couple $100, they're not going to spend the money to file court proceedings to make it a lien.
Gotcha. And what about talk about hard inquiries on credit report?
So a lot of people say, oh, we'll do a soft pull. There's really not much of a soft pull. What they're probably talking about at that point is that they're only going to pull one of the 3 bureaus. But I would tell you, by me pulling your credit report, I can show you a lot more of how I can improve your credit report than the 3 points it's going to cost you on your credit report for me to pull it. Now, in 1978, there was an act that came out that, such as when you're shopping for a car, you're shopping for a mortgage, you're shopping for something, and it's within the same industry, you can have your credit pulled by several different people within that same industry, and it only affects your credit score one time. So a lot of people will try to convince you, oh, don't shop with nobody else because it'll hurt your credit score. That's not accurate, and that's not true.
Got it. All right. So guys, we're going to go ahead and wrap up real quick. And man, a lot of great info. Thank you so much, Mr. Aaron, for co-hosting with us today. And,
absolutely.
So we're going to go ahead and close this thing out. So the path to home ownership, save your assets, save for down payment. But like Mr. Aaron said, don't allow or don't let lack of assets deter you from applying. Right, apply first to see where you are, and we're going to go coach you through the process. Don't die from paralysis of analysis. Right, know your credit scores as much as possible. You mentioned some things like the credit karmas and different things, which are unweighted scores, but at least it gives you an idea of where you are. And but when in doubt, take an application. Right, find you a good real estate agent. I'm going to tell you right here, no matter where you are, South Florida, I see somebody up in Ohio, Miss Kay Bailey's in Ohio, right? Man, reach out to us. We help assist you no matter where you are. We have vast networks to be able to help assist. So don't allow demographics or location to deter you from reaching out to us, and allow us to help you through the process. Your pre-approval, Aaron will help you with that. Like he mentioned, taking the application, and he'll coach you through what needs to be done to help get you in a better position if you're looking kind of rough right now. If you're good to go, we're going to get that thumbs up. And then from there, we're going to take that pre-approval letter, yourself and myself, and we're going to go out there and start shopping for a house. I got the fun job, right? I get to go house shopping with you, dream with you, right? Okay. Make an offer, have a home inspection, get an appraisal. We have a scheduled closing date, and then we get on Instagram and Facebook with our sign, and we can do this here on Instagram and show all our friends that we are homeowners. And that's the path, okay? And so we're here as coaches, guys, and consultants are going to help you through the process. It could be a scary process, it could be a very, very involved process, but that's why you hire professionals to help you win the game, right? Okay. And Walt Disney say the way to get started is to quit talking and begin doing. Quit talking and begin doing. Now, I'm going to drop a participation survey link in the chat, and I want you to take that link, open it up, and once we're done here, we want you guys to fill it out. Let us know how we did. If you have any additional questions on there, you can throw those on there. Also, if you have any referrals of anybody right now who may need anything that we discussed today, whether it's home ownership, or it could be any of the financial services or products and things that we've already helped assist you guys with in the past. Man, any referral you send our way is greatly, greatly helpful, and we thank you in that aspect. All right, do me a favor, take a quick screenshot of all the social media platforms we're on, so you can follow us at Legacy Builder One. That's our Facebook, Legacy Builders M Conaway. In parentheses, there's a bunch of Legacy Builders on Facebook, so that M Conaway in parentheses is going to distinguish. We also have a private home ownership group on Facebook, right? You can screenshot this with your phone or take a picture of it. Our home ownership group on Facebook is Legacy Builders Home Ownership Group. Is a private group. We're also going to post Mr. Aaron's information in there today, and we're also going to send you guys a recap recording of this session today. That way, if you wasn't able to take notes, you can play it back. On Instagram, we're at Team Legacy Builder 904 on Instagram. Go by there, follow us there as well, and that's my contact number here. I'm also going to post real quick Aaron's info. All right, you can screenshot it. Aaron, I got the loandepot.com/loan officers. Hey, Dewey.
Yeah, it's easier just to go to Aaron, AARONDUEZ.com. So my first, my last name.com will take you to that website.
Gotcha. All right, here we go. So you screenshot this real quick. It comes to the same website?
Comes to the exact same website.
All right, so let's see here.
The other one's just more difficult, but if you can remember Aaron and then the Duez, that will take you to my website, AARONDUEZ.com.
All right, so let me zoom in, guys, on the contact info so we can screenshot that. I posted a link earlier. All right. That should be good right there. Everybody screenshot that real quick. Once you got it, say got it in the microphone. We got 3 got it. We're going to take it down.
Don't leave me hanging.
Got it.
Got 3 guys. All right. So Aaron, close us out with some pump up, some words of encouragement as we help these new homeowners reach their goals and destinations. You got the last couple seconds.
Man, I got to tell you, there's nothing but opportunity in the world, and the people who want the opportunity are going to seize the opportunity. So if you're sitting on the sideline and you never want to be in the game, you're always going to be the water boy. Don't be the water boy. Be the one standing, tugging on the coach's shirt saying, put me in, coach, put me in. I'm ready.
I like that.
Bring
I like that. Well, guys, we thank you so much for being on here today on a doggone weekend, holiday weekend. You guys showed up and showed out. We appreciate you, Crystal F, Marie Hudson, Kay Bailey, Sabrina Rackert. Who else we got on here? Charity Stewart, Mr. Go Get It. We know he's gonna get a house because his name is Mr. Go Get It. Ishmael, Tierra, Devon, Charletta, and Mr. Aaron Dewey. Thank you so much, guys, for being on here today. We'll talk at you at the next session.
Thank you, guys. God bless.
Right, thank you.